Imagine you start putting away just $500 a month. You don't think about it much, but years later, wow, you have over $3 million. Sounds unbelievable, right? But it's not magic. It's the power of compound growth working for you. In this video, we're going to show you just how much you could end up with if you invest in the S&P 500 for 5, 10, 20, 30, or even 40 years. Believe me, when you see these numbers, you'll think differently about investing. Ready to dive in? Let's go. First things first, what is the S&P 500? The S&P 500, short for the Standard, and Poor's 500, is an index that tracks the stock performance of 500 large companies listed on stock exchanges in the United States. It's a market cap-weighted index, which means companies with a higher market value have a bigger impact on the index's movements. The S&P 500 is widely regarded as one of the best single gauges of large-cap U.S. equities. Because it includes companies from all sectors, it's often used as a benchmark for the overall performance of the U.S. stock market. More than $11.2 trillion is indexed or benchmarked to its performance, making it a crucial part of the financial landscape. Companies must meet specific criteria to be included in the S&P 500, such as a market cap of at least $8.2 billion, adequate liquidity, and positive earnings over the most recent quarter and the sum of the 4 preceding quarters. The index is known for its diversity, including tech giants like Apple and Microsoft, which are among the heaviest weighted stocks due to their large size. Historically, the S&P 500 has delivered an average annual return of about 10%, although this can vary widely year over year. This return doesn't just reflect price appreciation, but also includes the effects of reinvesting dividends. Investing in the S&P 500 is typically done through index funds or ETFs, exchange-traded funds, which replicate the performance of the index. The importance of the S&P 500 extends beyond just investment returns. It's also a key economic indicator, helping assess the health of the United States economy and investor sentiment. Fluctuations in the index can indicate broader economic trends, often making it a subject of analysis for predicting economic health. If you're considering investing in the S&P 500, it's recommended to look into index funds or ETFs that track this index. This approach offers diversification and a relatively low-cost way to own a piece of the 500 top U.S. companies, investing for 5, 10, 20, 30, and 40 years. Let's explore the growth of a monthly $500 investment in the S&P 500 across various time frames. After 5 years, early returns. With a total investment of $30,000 and an average annual return of 10%, your portfolio grows to approximately $49,500. This gain of $9,500 demonstrates how even modest returns can start building your investment pool early in the process. After 10 years, building momentum. By now, you've invested a total of $60,000. Thanks to the power of compounded growth, your portfolio value increases to about $95,000. This results in a gain of $35,000, illustrating how a decade of disciplined investing can begin to reveal the true potential of compound interest. After 20 years, the growth spurt. At this point, your total investment reaches $120,000. Compound interest works its magic, boosting your portfolio to approximately $344,000. With a gain of $224,000, 2 decades of investing transform your contributions into a significant nest egg, showcasing substantial growth. After 30 years, entering wealth territory, your consistent savings increase your total investment to $180,000. Compounded returns now swell your portfolio to about $1.13 million, a net gain of $950,000 from compound interest alone. As you near retirement, the profound impact of long-term investing becomes clear, transforming regular contributions into a millionaire's portfolio. After 40 years, achieving generational wealth. With a lifetime investment of $240,000, the compounded returns skyrocket your total to a staggering $3.1 million. This results in a gain of $2.86 million, primarily from compound interest. This final stage underscores the pinnacle of strategic, long-term investing, potentially establishing wealth that can impact multiple generations. The importance of starting early. The critical advantage of beginning your investment journey early cannot be overstated. Starting early allows more time for your investments to benefit from compound interest, where the returns on your investments generate their own returns. This effect accelerates over time, turning modest initial amounts into significant sums. Here's why starting sooner rather than later can make such a big difference. 1. Compound growth. The longer your money is invested, the more time it has to grow through compounding. This means that not only do your initial investments earn returns, But those returns also start generating returns of their own. Over decades, this compounding effect can result in exponential growth of your wealth. Risk mitigation. By investing over a longer time horizon, you can afford to take on slightly higher risk and potentially higher return investments, since you have more time to recover from any dips in the market. 3. Behavioral benefits. Starting early helps develop disciplined saving and investing habits, which are crucial for long-term financial success. It also reduces the psychological impact of market volatility, as you're more focused on long-term gains than short-term fluctuations. Increased total contribution. Starting earlier means you can spread your investment contributions over a longer period, reducing the financial impact of each contribution on your current lifestyle. 5. Taking advantage of retirement accounts. Early investments in retirement accounts like 401ks or IRAs can grow tax-deferred or tax-free, maximizing the benefits of compound growth. 6. Educational opportunity. Engaging with investments early on provides a valuable education in financial markets, investing strategies, and the economic factors that impact investment returns. The power of time and consistency. The ultimate lesson in investing in the S&P 500 is the importance of patience and consistent action. Over the decades, the S&P 500 has shown that despite short-term fluctuations, its trajectory has generally been upward. The history of the stock market shows us that while there will be downturns, the overall long-term trend has been positive. For instance, despite various crises and market corrections, the S&P 500 has continued to grow over the long term, reflecting the resilience and growth of the underlying businesses. One of the most common pitfalls in investing is attempting to time the market. This strategy is not only stressful, but also less likely to yield the optimal long-term results. Instead, consistent investments over time, regardless of the market's short-term performance, allow investors to benefit from what is known as dollar-cost averaging. This strategy involves regularly investing a fixed amount of money, which buys more shares when prices are low and fewer when prices are high, averaging out the cost over time. Think of your investment like planting a tree. Initially, the growth is slow and not very noticeable. However, as time goes by and you continue to nurture it, the growth accelerates. This is similar to how compounding works in your investments. With each passing year, the returns from your investments generate their own returns, leading to exponential growth over time. Just like a well-planted tree eventually provides shade and fruit, a well-maintained investment portfolio grows to provide financial security and wealth. The key is not just the initial act of investing, but also maintaining the course, adjusting as necessary without making hasty decisions based on short-term market movements. All right, that's a wrap. What do you think? Are you investing in the S&P 500? Let me know in the comments below. And if you found this helpful, make sure to hit that like button and subscribe for more quick, no BS financial lessons. Remember, the best time to start investing was yesterday. The second best time? Today. Thanks for watching, and I'll see you in the next one.